would love to hear some of your OG talking points. I would love to hear how you got into this space. I would love to hear how you articulate life insurance. I would love to hear that. Let's try to do our best to create a lightning in a bottle. And I'm going to hand it over to you and we'll have this conversation. But I really want to get your message and how you articulate it, because you're a big fan of life insurance. You're a big fan of talking about taxes. Your idea of retirement's very interesting. And I think it would be a shame if I did too much talking in this combo.
Oh, well, you're the one who's going to guide this ship. So that's great. My career changed. I guess it was when Matt said, you got to watch Simon Sinek. And I said, I have no idea who Simon Sinek is. And, his TED Talk, it's number 1 or number 2 still.
Start with why.
Start with why. And when you think about it, if I tell you what I believe and why I believe it, and if I can find that you're interested in that, we have a great relationship. But if I tell you what I believe and you go, I hate it, you have to convince me to do this, I'm setting myself up for weeks of horrible treatment. Weeks of absolutely despising this business. I don't want to do that anymore. I only want to work with people who see the light. So I'll start by telling them what it does, how it works, why it's different. And there are ways in the United States tax code that you can create as much wealth as you want off the radar screen of the IRS for income tax purposes using the rules and regulations in the tax code. 22% of all the cash value and all the insurance companies are owned by the wealthiest 1%. What do they know the average American doesn't? A lot. And when I first learned this strategy, I did 6 months of research because I was an equity guy. I was chasing rates of returns. That was my story. You're getting 6, I can get you 8. Right. And then when I realized 8 doesn't mean crap if I got to pay taxes, federal, state, local tax on Social Security, Medicare premiums, advisor fees. If you follow typical financial advice, you're paid 7th in line.
That's crazy.
And I love this statement. The city and state you live in on the day you retire, right? And how much you have, let's see, how does it go? The city and state that you live in and where your money is parked will have more of an impact on the quality of your retirement than the investment. Forget rate of return. Forget, Chase. Most of the stuff we were talking about today was, how do you mitigate the rate of return risks? How about get rid of it completely? And when you look at what the wealthy are doing and how they're spending money and not paying any income tax, these guys that owe estate taxes are buying life insurance and putting it in their own name. So when they die, there's an estate tax due. But the insurance company is always going to give them $2 for every dollar they got to pay. But they get to use it tax exempt all of their life. And the pet peeve that I have in this business, I'm so tired of hearing the word tax-free income. You're too young, Caleb, but this was in the 80s when Metropolitan took out a full-page ad in the Wall Street Journal on the center. So when you opened up the journal, the title of the article, Cheat the Government. Who else reads the Wall Street Journal besides... And the tax law changed within 2 or 3 years after that.
Are you talking about Mac?
Yes.
Yeah.
So income is 100% taxable. Always is, always will be. So when we go out there and talk about tax-free income from insurance products, we are shooting ourselves in the foot.
Yes.
It's cash flow. It's a loan. It's collateral. It is the most efficient use of collateral there is. I'm borrowing against an account that the insurance company guarantees to be worth more tomorrow. I can't lose. And the only one who does lose is the government, but I'm following their rules on how to build it. So if you build it correctly, you can put in as much of your net worth as you want so that the distributions by law have no place to put on a tax return. And there are 6 tax codes that use the word exempt, where distributions cannot be put on a tax return. And they all reference cash value life insurance. So if people truly understood what the tax code says, I've been audited enough times and the auditors, they start off with the same thing. Mr. Love, we hope you win. Yeah, right. And then
is that actually what they say?
And then the next thing they say is our job is to enforce what Congress passes. Our job isn't to teach you what's in the tax code. So if these tax codes have been around for 120 years and you've never looked at them, whose fault is that? If most people knew how wealth works, taxes work, you'd probably change direction of where you're headed. Most people, and we both live in Nashville, there's a radio host, a radio entertainer that talks about, pay cash for everything and maximize your 401k. And when you retire, you'll be debt free. That is a potential problem. You're not debt free. You have the biggest debtor in your life, the Internal Revenue Service. You have no idea what you owe. And I think there should be an issue. I'm not debt free when I have $1 million in an IRA or a 401k. I owe $350 to the Internal Revenue.
Or if they change
whatever the new rule will be.
Yes.
Correct. So if you really want to mitigate the risk, if you really want to build a plan that is not going to fail you, this is the best. Let's get rid of those external effects that could negatively input the performance I'm going to enjoy. Mm-hmm. Get rid of them. Rather than mitigate all these risks and the formulas and the withdrawal rates. And how about if you understood how much you'd have to earn at an Edward Jones or a Raymond James account to spend as efficiently as what we do? You'd have to earn over 20% a year, every year, for the rest of your life, to spend as well. I qualify for food stamps, government cheese, free cell phones, Obamacare, and I don't have to file a tax return on the money that we use with the strategy.
Okay, so you're saying a lot of different things. So you're saying we use in this space, and we do it all the time, we're using the word income, and you're saying even by using the word income, we're cheapening life insurance, because when you take a loan against your life insurance, it's not income, it's cash flow. And by definition, or it's really a loan.
It's a loan.
And loans are not taxable. Elon Musk does this when he takes a loan against his businesses.
Walt Disney started Disneyland with a loan.
And so you're saying and now loans can be problematic because they can get out of control, but life insurance has built-in features to make sure that these loans won't get out of control and that you're hedging a couple sides. So is that what you're saying first and foremost with tax-exempt cash flow versus income?
Yes, and also I don't want to antagonize the government. I don't want to cheat the government.
Yeah,
I think we are doing ourselves a disservice by not cheapening, but by using language that really is not accurate. This isn't income. It acts like income. It's spendable as income, but it's not income. The money does not show up on a tax return, just like borrowing your first money on your house. Yep. The bank lent you borrowed money, but they sent that big check to the seller. You don't have to pay tax on that. Why? Because you're going to pay it back eventually. Well, you're going to pay back your life insurance loans too, at death. At death, and Brian Bloom was the one who coined this phrase. You're borrowing against your dead self. The IRS will allow you to live on exempt money, your death benefit, free of income taxes with your family while you're alive. I can't think of a better way to spend, and the only one who loses is the government, and we're using their rules. They're telling us how to build this, and if we build it correctly, you never have to look at income taxes again on that.
Yeah, and the reason the government does give some really amazing tax benefits is if everyone had life insurance, we wouldn't have all these welfare programs.
True.
And so, while yes, it's you're benefiting, you're also not a drag to society, and that has ripple effects for society as well. The buy, borrow, die strategy is what a lot of people are coining, and you look at Jeff Bezos and Elon Musk and all these people, and that's the whole concept. Explain how when you use life insurance, how that really self-completes in a perfect way.
So there's recourse loans, which everyone in the United States is aware of. I borrow money from an asset against an asset. The bank loans me money and I have to make recurring payments. And if I miss a few payments, the bank has the right to pull back the collateral. We use non-recourse loans. Life insurance are non-recourse. They don't use credit bureaus. There is no tax returns. If you need money, they will lend it. But they're lending you against your money. So it works like this. If you call in and say, I want to borrow X number of dollars, they're going to go down to the drawer and they're going to pull it up and look at your policy and they go, oh, you got plenty of cash. Absolutely. Give them the money. That money never leaves the policy. It stays in the contract. There's no risk to the insurance company because they already have it. You miss a payment, that's okay. There is no fixed payments. Now, they will send you a bill once a year for interest, but you don't even have to pay that. That's added on to the loan. The neat thing about what life insurance, and Caleb, this took 29 years for me to learn.
I hope our audience can appreciate that you're literally getting 29 years. By the way, I'm 29 years old as we speak.
Well, I've been in the business 48, but it was 29 before I recognized when I borrow money from an insurance company, I'm not borrowing my money. just like when you have equity in your home, you're not borrowing. You cannot take your garage door off with the beveled glass, the nice garage door, go to the bank, put it in their vault and say, give me money on that. They'll go say, put it back on your house. We'll lend you the 50,000 you need, but we'll use the whole house as collateral. Life insurance is exactly the same way. And you have to pay back the bank. Well, not with a non-recourse loan. You don't have to. And if you don't, when you die, the death benefit is simply reduced by the amount of the loan. I want to recite for you one paragraph of a report done in 1990. The General Accounting Office was petitioned by Congress to determine how successful they were at stopping the sale in the 80s of single premium whole life. So it's a 67-page scathing report negative about the insurance industry. And it's all about Congress. You're losing billions because you can't tax this, you can't tax that. But there's one paragraph on page 27 that talks about, for all the congressmen and senators that have no idea what the problem is, this is the issue. For all the morons that didn't know what was going on, this was the problem. And I'm going to recite it for you. If a policyholder borrows against the inside buildup from his or her life insurance policy, the amount borrowed is considered a transfer of capital and not a realization of loan, and therefore is exempt from taxation. This is in accord with other consumer loans like mortgages and automobiles. If a policyholder chooses to borrow against the inside buildup, the amount of interest income that is supposed to be used to fund a death benefit can instead be a source of untaxed current income. And if the policyholder should die with the loan outstanding, the death benefit is simply reduced by the amount of the loan, thus allowing the policyholder the use of tax-free money all of their life. I couldn't have paid government money to write a better paragraph as to why I do what I do.
Let's not drop the mics, but that's a pretty mic drop moment. So you learned this 29 years ago.
That I'm borrowing against it, not from it. My policy cash value does not change. My policy, all of it's earning dividends.
Yes.
All of it's at a guaranteed cash value rate. I have $3.5 billion of clients' money that isn't subject to political influence. I could care less who's in the Oval Office. Not subject to stock market gains or losses. Every dime of it is guaranteed to be worth more, and not a penny of it is going to show up on a federal or state income tax return. All using the rules and regulations that's been in the tax code for 113 years. Why doesn't everybody know this?
Why doesn't everyone know this?
If I'm a fee-based financial planner and I've convinced you that chasing rates of returns is the solution, because I charge more when you make more. We've seen all the ads, right? Mm-hmm. So there's no incentive for a fiduciary to tell you that if you need $5 with what I'm doing, you could do the same with $1.50 in cash value. Because that's going to take money from them.
Yes.
And if the client does hear that you can do it with $1.50, what are they going to say about that person? Oh, they're worthless. It's just a commission sale. They don't care about you. This is all about the wonderful of picking the stock winnings. And no, it's how do I spend my money? And here's what's really interesting, Caleb, and this is 50 years of practice. There's really two kinds of advisors. There's the advisor that talks about how to accumulate money. And they're good at the accumulation side. But if that's the same person you're hiring to have a conversation about the distribution side, you're only going to get half the story, because there's incentive to not really let you spend your money. And the only reason why people save it is to spend it. Yep. So you need an advisor. It's a different mindset. It's a different skill set. You have to understand how to mitigate the income taxes, because there's a rippling effect. Your advisor might talk to you about the state tax, or the federal tax. You might have to pay the Fed. No, there's a federal tax, a state tax, maybe a local tax, a tax on Social Security, a Medicare premium increase, the financial advisor's fee. And then you're
number 7.
You're 7, number 7 in line. And you are anything but debt free on the day you retire.